One late night announcement wiped out $19 billion in a single day. It triggered the largest one-day crypto crash in history, sending thousands of investors into panic. Imagine waking up to find your life savings on the line because of a 100% tariff tweet from the president. That's exactly what happened. In this video, we're diving into the 2025's wildest financial roller coaster and the simple money lesson that could save you from disaster. Quick heads up, I'm not a financial advisor. This is just educational content, so do your own research. Meet John, 32 years old, ambitious, and about to gamble everything. He watched Bitcoin rocket past $125,000 to a new record high, and the headlines made it feel like free money. Everyone from Wall Street suits to his next-door neighbor was piling in. Even the government seemed on crypto's side. Institutional money was pouring in under friendlier policies from a new administration. John felt like he'd discover a cheat code. This was his chance to skip the grind and get rich quick. If I can't beat these returns, I have to join them, he thought, recalling a viral quote, "Bitcoin is the hurdle rate. If you can't beat it, you buy it," one influencer declared. John was all in. He emptied his savings and even took out a loan to maximize his bet. Yes, he borrowed money to buy crypto. He wasn't alone in that crazy move. Surveys show about 1 in 5 investors have done the same. This was more than investing, it was faith in a financial rocket ship. For a brief, glorious moment, John's gamble paid off. Bitcoin kept climbing, and within days, his portfolio ballooned. His $50,000 stake shot up to $100,000 almost overnight, an eye-popping gain. John felt like a genius. This is actually happening. I'm going to be a millionaire. He was planning a new car, an early retirement, maybe a yacht, why not? Each morning he checked his account with giddy excitement as the number ticked higher. This was the mini payoff dreams are made of. John's beliefs seemed vindicated. The risk, the debt, the doubters, all wrong. He was riding the high of hype, and it felt like flying. But then came the fall. Just as John was getting comfortable on cloud 9, reality struck. Late one Friday, news hit. The president announced a sudden 100% tariff on Chinese imports. In the blink of an eye, fear ripped through the markets. Crypto prices plummeted. John's phone lit up with alerts. Bitcoin down 5%, 10%, 15%. His favorite altcoin, ironically named Hype, lost over half its value in a flash. This wasn't a dip, it was a free fall. John's $100,000 paper fortune shrank to $60,000, then $50,000 below his starting point. Thousands of others were liquidated in the carnage. It was a $19 billion wipeout, the biggest ever. John's heart pounded. No, this can't be happening. But it was. The same rocket that shot him to the moon had exploded mid-flight. This 2:30 a.m. crash was the ultimate nightmare scenario, and it was unfolding in real time. John was in free-fall panic. He'd never seen so much money vanish so fast. In the frenzy of red numbers and gut-churning fear, he did the worst thing possible. He hit sell. John sold nearly everything in a blind panic, desperately to save what he could. In seconds, his dream run was over. Losses kicked in. He soon learned that if he had held on just a bit longer, things might have been different. Over the weekend, the very same president softened his tone. It will be all fine, he assured, easing the trading scare. The crypto market actually bounced back a bit as calm returned. But John had already abandoned ship at the worst possible moment. By Monday, Bitcoin was stabilizing, but John's portfolio wasn't. He'd cashed out at the bottom. Now he was left with just crumbs of his investment, plus a hefty loan to repay. The high flyer of yesterday was the devastated cautionary tale of today. In the aftermath, John sat in stunned silence. The excitement was gone, replaced by guilt, fear, and a crushing sense of regret. How did his sure thing turn into a financial disaster practically overnight? Where did he go so wrong? I can't believe I risked everything. What have I done? The game that he'd thought he'd mastered had chewed him up and spit him out. John wasn't just broke, he was broken. This was his wake-up call. John's dream of quick wealth had become a harsh lesson. It's a story as old as money itself. Chasing the next big thing can feel like flying until you hit the ground. If you found John's journey eye-popping, take a second to breathe. And hey, if you're glad you're learning this lesson vicariously, consider subscribing to our channel. We break down financial insights like this every week so you can stay informed without risking your shirt. Go ahead, hit that subscribe button and join our community. It's a lot safer than betting the farm on a tweet, right? John's story might sound extreme, but it isn't unique. Far from it. This cycle of boom and bust happens over and over, to pros and amateurs alike. In fact, nearly 21% of crypto investors admitted to taking out loans to buy in, a whole army of Johns chasing that high. And it's not just crypto. Remember the dot-com bubble? In 2000, people poured money into hot internet stocks with zero profits, convinced they'd find the next gold mine. When reality hit, the Nasdaq index plunged 75%, wiping out over $5 trillion in wealth. Yes, trillion with a T. Fortunes evaporated, dreams shattered. Sound familiar? More recently, think of the meme stock mania with GameStop and AMC in 2021. A few made out like bandits, but countless latecomers got burned when those stocks crashed back to earth. The pattern is always the same. Hype inflates, then implodes. It's a tale as old as financial markets, yet we keep reliving it like it's brand new. Why do some people fall for it? Because greed and fear are powerful forces. The promise of quick, life-changing gains makes us ignore risk, and the pain of losses makes us panic at the worst time. It happened to John. It happened to millions before him, and it will happen again to others. But you don't have to be next. To break this cycle, we need to understand the timeless money lesson hidden in these stories of mania. So, what's the lesson John learned the hard way? It boils down to the classic fable of the tortoise and the hare. In investing, the hare is the hot type, sprinting ahead with flashy, explosive gain. Think Bitcoin's meteoric rise. The tortoise is the slow and steady strategy, boring at times but relentlessly consistent. Think broad index funds or diversified investing. Time and again, slow and steady wins the race. Don't just take my word for it, let's look at the numbers. Studies show up to 95% of short-term traders lose money. The vast majority of people who chase quick profits, day trading stocks, timing crypto swings, end up poorer, not richer. Meanwhile, the S&P 500, a benchmark of the stock market, has returned about 10% per year on average for decades. That kind of consistent growth compounded turns modest investments into small fortunes over time. And it comes with far less drama and sleepless nights than any get-rich-quick scheme. Here's what that means. If you simply put money into a low-cost index fund and patiently let it grow, you historically could double your money roughly every 7 to 8 years, thanks to compounding about 10% annual returns. All while John and the hares of the world are riding a financial roller coaster, screaming on the way down. Sure, the tortoise approach isn't sexy. It won't make headlines or Reddit threads, but it works, quietly and reliably. John finally saw it. After the crash, he had a choice: continue being the hare, forever chasing the next big score, or become the tortoise, steadily building wealth without risking ruin. It wasn't easy, but he chose to change. John paid off his remaining loan and started fresh with a new mindset. Instead of YOLOing on the next coin or meme stock, he began investing in a diversified portfolio, a bit of broad stocks index funds, some bonds, even a savings cushion. He set up automatic monthly contributions and swore to never bet on what he couldn't afford to lose again. The result? For the first time in years, John could sleep at night. No more 3 a.m. panicked phone checks. His money was growing slowly, quietly in the background. 3 months after his disastrous gamble, John's modest new investment were up a few percent. Nothing flashy, but solid. It felt boring, but absolutely wonderful. The truth is, wealth is a marathon, not a sprint. The tortoise beats the hare not because it's faster, but because it's steadier. John's wild ride taught him that a slow climb that actually reaches the finish line beats a swift leaf that faceplants halfway. Think about it. Would you rather have a 90% chance at comfortable wealth eventually, or a 10% chance at uber wealth quickly, with a 90% chance of losing it all? Most of us win not by losing. It's about playing the long game. And here's the kicker. By staying consistent and avoiding big mistakes, you'll likely end up ahead of those who look like winners in the short term. The race isn't over after the first mile. In the end, the steady path not only gets you there, it keeps you there. Now it's your turn to choose. You've seen the hype and you've seen the aftermath. What kind of investor do you want to be? Chasing quick hypes can be thrilling, no doubt, until it isn't. The slow route can feel dull, until you realize it quickly made you financially free. You don't have to swear off all risk or never touch exciting investments, but do it with a plan. Diversify so no single bet can ruin you. Discipline yourself to take profits and cut losses rationally, not emotionally. And most of all, be patient. Let time and compound growth do the heavy lifting. Millions have built wealth the boring way, and you can too. John's story isn't a prohibition, it's a preparation. Use his lesson to make smarter moves with your own money. Picture yourself a decade from now, not worrying about every market wobble, not checking prices hourly, but sitting comfortably because you made consistent, sane decisions. That financial peace of mind, that's the real reward here. It's achievable, and it's far more common among the tortoises of the investing world than the hares. Slow and steady can win your race. Before you go though, consider this. Even if you avoid the hype traps, there's a stealthy financial villain lurking that can quietly eat away your wealth. It's something affecting everyone right now, including you, and most people don't guard against it properly. It can make your hard-earned savings worth less each year without you even noticing. Want to know what it is and how to beat it? Check out our next video where we expose the silent money thief and show how to protect yourself. Trust me, you don't want to miss it. It might just be the next essential lesson for your financial survival. See you there.